Have you ever had this moment where you check your bank account and technically you're doing okay? Like you're paying your bills, you're not overdrafting, your credit score isn't terrible, but for some reason, every time you apply for a loan, refinance, ask for a credit limit increase, or even try to get better interest rates, it feels like the system is quietly saying, yeah, you're not that good. And you can't figure out why, because no one ever tells you what they're actually measuring. You're playing a money game where the rules exist, but you're never shown the scoreboard. And here's the frustrating part. Banks are absolutely judging your financial health using very specific benchmarks, and most people never even realize those benchmarks exist. If you're someone who works hard, pays their bills, but still feels financially stuck or constantly behind, make sure to hit the subscribe button and give this video a thumbs up if this helps you out, because today, I'm breaking down the 6 financial benchmarks banks use to decide how safe, valuable, and trustworthy you are. Benchmarks that never show up on your bank app, never get explained, and quietly control your financial future. And once you see them, you cannot unsee them. Challenging a common assumption. Here's the thing. Most people think banks care about income. They don't. Then people think banks care about credit scores. They do, but not nearly as much as you think. Banks care about patterns, buffers, and behavior under stress. They don't ask, does this person make money? They ask, what happens when something goes wrong? And this is where it gets really interesting. Benchmark number 1, liquidity buffer, the real emergency fund test. Let's start with the one almost no one talks about. Banks obsess over something called liquidity buffer. That's just a fancy way of asking, how long could this person survive if income stopped tomorrow? Most financial advice says you need 3 to 6 months of expenses. Banks quietly expect more. According to internal risk models used by major U.S. lenders and confirmed by Federal Reserve stress test disclosures, borrowers with less than 2 months of liquid cash are considered high risk, even if their credit score is excellent. Let's put numbers to this. If your monthly expenses are $4,000, 2 months equals $8,000. 6 months equals $24,000. Now, here's what most people don't realize. If you have $5,000 in checking, $50,000 in retirement, $20,000 in home equity, the bank still sees you as cash fragile because retirement money is locked. Home equity is slow. Only liquid cash counts. Psychologically, this is brutal because people feel wealthy without being liquid, but banks don't care how rich you feel. They care how fast you can pay. Benchmark number 2, debt service coverage. The can you breathe ratio? This one quietly destroys people. Banks calculate something similar to what businesses use called debt service coverage ratio, DSCR, even for individuals. In plain English, they ask, after all fixed payments, how much oxygen is left? Let's say you earn $6,000 per month after tax. Your fixed debts are $3,900. That leaves $2,100. Sounds okay until something happens. Banks want to see at least 40 to 50% of your income free after debt payments. Most Americans, they're closer to 20 to 30%. According to the Federal Reserve, nearly 60% of Americans couldn't cover a $1,000 emergency without debt. To banks, that's not a budgeting issue. That's a fragility signal. Here's the psychology. When humans feel squeezed, decision-making collapses. Banks know that. So they don't just measure your ability to pay, they measure how calm you are while paying. Benchmark number 3, cash flow stability. Consistency greater than amount. Now, you might be thinking, I just need to make more money. Not exactly. Banks would rather lend to someone making $65,000 consistently than someone making $120,000 inconsistently. Here's why. They track income volatility, deposit timing, frequency of balance dips. If your account repeatedly hits near zero before payday, that's a red flag, even if you always recover. This is where it gets really interesting. 2 people. Person A saves $500 monthly steadily. Person B saves $6,000 once per year. Same annual savings. Banks trust person A more. Why? Because behavior predicts future behavior, and humans underestimate how much consistency matters. Benchmark number 4, utilization behavior, not just the percentage. Everyone knows the 30% credit utilization rule, but here's what banks actually look at. They don't just look at how much you use, they look at when you use it,
how often you max out, how fast you pay it down. Someone who occasionally spikes to 70% utilization but pays it off quickly is less risky than someone who sits at 35% permanently. Why? Because persistent utilization suggests lifestyle inflation, dependency, no margin. Here's the analogy. It's like breathing. Holding your breath once, fine. Never fully exhaling, problem. Benchmark number 5. Net worth trajectory. Direction matters more than size. This one shocks people. Banks don't care about your net worth number. They care about where it's going. Someone with $25,000 net worth growing steadily is often viewed more favorably than someone with $150,000 net worth stagnating. Why? Because upward trajectory signals discipline, margin, learning behavior. According to data from J.P. Morgan Chase Institute, households with positive net worth momentum default far less, even when balances are higher. Psychologically, momentum changes how people act. People protect growth. People neglect stagnation. Benchmark number 6. Stress response history. Your past under pressure. This is the one nobody talks about. Banks look at how you behaved during stress. Examples: did you miss payments during layoffs? Did you rack up high-interest debt during emergencies? Did you drain accounts completely? They track patterns during 2020, inflation spikes, job changes. Now, you might be thinking, that's unfair. People go through things. I agree, but banks don't reward fairness. They reward predictability. And here's the hard truth. The best time to look financially responsible is before you need help. What this all means for you. Here's what most people don't realize. You don't need to be rich to look financially strong. You need liquidity, margin, consistency, calm under pressure. And the best part? These benchmarks are trainable.